Hello guys, my name is Prabhanshu. My group number is 26. So we have three group member in this group, Vikrant, Jasmine, and myself. So topic of my presentation is accounting system and processes. First of all, I'm going to talk about statement of cash flows in direct method. The statement of cash flows for Lodh Limited for the year ended 30 June 2017, prepared using the direct method of presentation. Summarize the cash flows, summarize the cash inflows and outflows from the company's operating, investigating, and financing activities. Cash flows from operating activities. It represents cash generated from core operation, which include income from operation, lease income, and gain on sale of machinery. Deduct expenses such as cost of sales, interest expenses, depreciation expense, insurance expense, and other operating expenses. Cash flows from investing activities reflect cash flows related to investments, include proceeds from sale of machinery and land, and cash outflow for purchase of machinery. The other point is the next point is cash flows from financing activities. Represent cash flows associated with financing, which includes payment of dividends and other financing activities. After that, its net increase and decrease in cash and cash equivalents shows overall change in cash and cash equivalents calculated by adding net cash flows from operating, investigating, and financing activities to cash and cash equivalents at the beginning of the year. Moving to the next slide. Now we are going to talk about an overview of recognizing intangible assets. Intangible assets are valuable resources that lack physical substance but hold significant value for businesses. This slide introduces the topic of recognizing intangible assets and highlights its importance in financial reporting. And the other, we have complexities and accurate recognition. Recognizing intangible asset can be challenging due to their intangible nature and the complexities involved in assessing their value. Accurate recognition is crucial to provide a complete and transparent representation of a company's assets and to enable informed decision making by stakeholders. Now we have definition and identification of intangible assets. Definition of intangible assets. Intangible assets are non-physical assets that lack a physical substance but possess value to a company. They are identifiable, non-monetary assets that are not held for sale in ordinary course of business. Criteria for recognition. Separability. Intangible assets can be separated from the company and sold, transferred, licensed, or exchanged independently. Control. The company has the ability to control the use and benefits of intangible assets. Example of intangible assets are customer lists, valuable database of customer information that provide a competitive advantage. Patents, exclusive right granted for inventions, innovations, or designs. Moving to the other slide, types of intangible assets, intellectual property, inventions, distinct sign, original work, goodwill. Goodwill represent the value of company's reputation, customer loyalty, and brand recognition. It arises from factors such as customer relationship, favorable brand perception, and established market presence. License and permits. License and permits grant legal right or permission to use certain resources, technologies, or intellectual property owned by others. Contract and agreements. Legal agreements conferring rights or privileges. Customer relationship. Build relationship leading to brand loyalty and potential revenue. Now my other team member will explain the other slide.
Like the upper slides are discussed by Prabhanshu. Now I'm discussing about importance of intangible assets. Intangible assets have become increasingly significant in today's knowledge-based economy. With the rise of technology and innovation, companies are placing more value on intellectual property, brands, and other intangible assets rather than just physical assets. Intangible assets can contribute to a company's competitive advantage by differentiating it from competitors. Brands, patience, and proprietary technology can create barriers to entry and establish a unique market position. Intangible assets also play a crucial role in long term value creation. They can generate revenue streams, enhance customer loyalty, and provide opportunities for expansion into new markets for product lines. Moving to the next slide, that is valuation challenges. Valuing intangible assets presents unique challenges due to the following factors. Number one, subjectivity. Valuing intangible assets often involves subjective judgments as there may be no universally accepted valuation methods. Different experts or app- appraisers may arrive at different conclusions, leading to potential variations in the reported value. Next is lack of observable market prices. Unlike tangible assets such as buildings or equipment, intangible assets usually do not have readily observable market prices. This makes it challenging to determine their fair value based on actual market transactions. Third is use of estimation techniques. Valuation of intangible assets often relies on estimation techniques such as income projections, discounted cash flow models, or comparables. These techniques introduce a level of uncertainty as they require assumptions about future cash flows, growth rates, and other relevant factors. And the next slide is
Uh,
recognition of research and development costs. Research and development costs are generally considered as expenses because they are incurred to discover new knowledge or improve existing products and processes. R&D costs are expensed as occurred because their future income economic benefits are uncertain and cannot be reliably measured at the time of expenditure. Criteria for capitalization and expenses R&D costs. R&D costs can be capitalized and recognized as an intangible asset if certain criteria are met. To be eligible for capitalization, the R&D project must meet specific criteria such as technical feasibility, intention to complete the project, ability to use or sell the asset, and generation of future economic benefits. Examples of R&D costs that may be capitalized include costs incurred for the development of new products, software, or patients.
Hello, my name is Vikrant Chauhan and I'll discuss about the another slides. And now we talk about the disclosure requirements. In financial statements, companies are required to disclose relevant information about the intangible assets. This includes providing details about the nature, type, and valuation of intangible assets. The specific disclosure requirements may vary depending on accounting standards followed by the company, such as generally accepted accounting principles or international financial reporting standards. Importance of transparent reporting. Transparent reporting is crucial when it comes to intangible assets, as it provides stakeholders, including investors, creditors, and analysts, with the necessary information to make informed decisions. Transparent reporting helps in assessing the value, risks, and potential impact of intangible assets on a company's financial position and performance. It enhances the overall transparency and credibility of financial statements and promotes trust among stakeholders. And now we talk about the challenges in recognizing intangible assets. Industries and companies have Different industries and companies have varying approaches to valuing intangible assets, resulting in a lack of standardization, valuing evaluation methods, and accounting practices. Subjectivity in valuation. Valuing intangible assets often involves subjective judgments, and estimation techniques due to absence of readily observable market prices, leading to potential discrepancies in the recognizing and measurement. Rapid technological advancement. Continuous technological advancements create new intangible assets, making it challenging for companies and accounting professionals to identify and valuing emerging intangible assets, which concludes that intangible assets are of utmost importance in today's business landscape, driving value creation and competitive advantages. As recognition standards evolve, companies need to develop effective strategies for identifying, valuing, and managing their intangible assets. Ongoing monitoring and transparent disclosure are essential to address changes in value and provide stakeholders with necessary information. By properly recognizing and accounting for intangible assets, companies can enhance decision making and foster trust among investors and the other stakeholders. Thank you.